When people think of success in the stock market, they often imagine overnight millionaires or lucky bets on hot stocks. But the truth is, most of the world's most successful investors didn't achieve wealth through luck or timing. They did it through patience, discipline, strategy, and an ability to see opportunities where others saw fear. Their stories and strategies can teach us how to approach the market with a long-term mindset and avoid the pitfalls that trap so many beginners. One of the most famous names in the investing world is Warren Buffett, often called the Oracle of Omaha. Buffett is the chairman of Berkshire Hathaway and has built his fortune by focusing on value investing. He looks for companies with strong fundamentals, reliable management, and a track record of success that are temporarily undervalued by the market. Buffett's philosophy has always been about buying businesses, not just stocks. He once said, if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes.
Ads!
This mindset has allowed him to avoid short-term market noise and instead focus on building wealth that compounds over decades. Buffett's story is powerful because it shows that patience, research, and discipline can outperform risky speculation. Another legendary investor is Peter Lynch, who ran the Fidelity Magellan Fund from 1977 to 1990. During his time managing the fund, it became one of the best-performing mutual funds in the world, averaging an annual return of around 29%. Lynch's strategy was simple but brilliant. Invest in what you know. He encouraged everyday investors to pay attention to the products and services they used, because chances are, if a company is winning in the real world, its stock will eventually reflect that success. For example, Lynch noticed people shopping at Dunkin' Donuts and using products from Hanes, which turned into successful investments. His story is a reminder that sometimes great investment opportunities are right in front of us. Then there's Benjamin Graham, often referred to as the father of value investing. Graham wrote the legendary book The Intelligent Investor, which Warren Buffett himself has often praised as life-changing. Graham's approach was about finding companies trading below their intrinsic value and ensuring a margin of safety. He believed the market often overreacts to good and bad news, which creates opportunities for disciplined investors. Graham's success wasn't built on flashy trades or speculation, but on careful analysis, risk management, and a logical framework. His philosophy remains relevant today for anyone looking to build wealth in the stock market. Another remarkable figure is John Templeton, who was known for his global investment strategy. Templeton believed in looking beyond the borders of his home country to find opportunities in emerging markets. At a time when most investors were only focused on U.S. stocks, Templeton saw potential in countries and industries that others ignored. He famously bought stocks in Japan during the 1960s. Long before it became one of the strongest economies in the world, his approach shows us the importance of diversification, open-mindedness, and being willing to go against the crowd. Philip Fisher also deserves recognition. Fisher was a pioneer of growth investing, and his book Common Stocks and Uncommon Profits influenced countless investors. Unlike Graham, who focused more on numbers and valuations, Fisher looked closely at the quality of a company's management, innovation, and ability to grow over time. He believed in holding on to stocks of great companies for the long haul, allowing investors to benefit from the power of compounding. One of his famous investments was in Motorola, which he held for decades. Fisher's philosophy blends perfectly with modern growth investing strategies, especially in sectors like technology. Ray Dalio, founder of Bridgewater Associates, is another giant in the world of investing. His hedge fund is one of the largest in the world, and his success comes from using macroeconomic principles to guide his investment decisions. Dalio studies global trends, interest rates, and economic cycles to position his portfolio. One of his most famous strategies is the all-weather portfolio, which spreads investments across different asset classes to perform well in any economic environment. Dalio's story emphasizes the importance of understanding the bigger picture and not just focusing on individual stocks. Then we have Jesse Livermore, often called the Great Bear of Wall Street. Livermore was a trader in the early 1900s who made and lost fortunes multiple times. He is remembered for shorting the market during the 1929 crash, making millions while others lost everything. His story is a powerful lesson in risk management, emotional control, and the dangers of overleverage. Livermore's experiences show both the potential rewards and risks of speculation. George Soros is another legendary investor known for his bold bets. He famously made $1 billion in a single day by shorting the British pound in 1992, an event known as Black Wednesday. Soros's strategy involved identifying weaknesses in economies and currencies and then positioning himself accordingly. While his style is very different from Buffett's long-term patience, Soros demonstrates that deep analysis, conviction, and timing can also lead to extraordinary success. We can also look at more modern investors like Cathie Wood, founder of ARK Invest. Wood focuses heavily on disruptive innovation, investing in companies shaping the future such as Tesla, Roku, and genomic technology firms. Her bold bets have attracted both praise and criticism, but she represents a new wave of investors who are willing to look decades ahead into transformative industries. Whether or not one agrees with her strategy, her success shows the importance of having a strong vision and sticking with it. Another modern success story is that of Charlie Munger, Warren Buffett's longtime partner at Berkshire Hathaway. Munger is known for his rational thinking, multidisciplinary approach, and ability to simplify complex decisions. He emphasizes the importance of avoiding big mistakes, rather than chasing big wins. Munger's wisdom reminds us that sometimes the best investment strategy is simply to be consistently rational, avoid emotional decisions, and stay focused on the long term. What all these successful investors have in common is not a single strategy, but principles that guide their decision-making. They all stress the importance of discipline, patience, research, and risk management. Some, like Buffett and Graham, focus on value. Like Fisher and Wood, focus on growth and innovation. Some, like Soros and Dalio, study global macro trends, while others, like Lynch, focus on everyday opportunities. This diversity of approaches shows that there's no one perfect way to invest. But success comes from having a clear philosophy and sticking to it. For new investors, the lessons from these stories are powerful. Don't chase quick profits or get caught up in hype. Focus on learning, building a strategy, and being patient. Understand the companies you invest in. Look at the bigger economic picture, and don't let emotions drive your decisions. The stock market rewards discipline and punishes impulsiveness. The most successful investors didn't become rich overnight. They played the long game, stayed committed to their principles, and adapted to changing conditions without losing sight of their core philosophies. Whether you prefer Buffett's value investing, Lynch's invest in what you know strategy, or Dalio's macroeconomic approach, the key is to find what works for you and stick with it. Success in the stock market is not about luck, it's about preparation, knowledge, and patience. Subscribe to Investero.